and their names and their titles. We are live.
All right.
So good afternoon for everybody. Also good morning for some of our colleagues who are participating from another continent, maybe others from now from continents in the evening. So let me give a very warm welcome to all for this important event on behalf of the South Center. Let me express in the first place our great satisfaction for organizing this event jointly with the Coalition for Dialogue in Africa, CODA, which is carrying out a very important work in the area of domestic resource mobilization, economic integration, other areas in Africa. So we're very, very pleased and very glad that we have a new opportunity to cooperate in organizing an event like this. Let me also thank the distinguished speakers we have for this session, speakers coming from 3 different continents as well. So very, very thankful for their contribution to this important event. Let me also thank the authors of the paper that will be discussed that has provided very useful information for the analysis of policymakers. As you know, the main objective of this webinar is to look at the outcomes of a study that was the result of a joint call between CODA and the South Center in order to quantify the implications of the amount A in the pillar 1 of the so-called 2-pillar solution of OECD on the one hand, and also the outcomes of the Article 12B of the UN Model Double Tax Convention. So this study is extremely important because it will provide some information to policymakers in order to make a very crucial decision, which is coming right now, whether to join, to adhere or not to the so-called 2-pillar solution of OECD, or to go for alternative solutions such as the Article 12B in the UN Tax Convention. So we are very, very glad to have this opportunity. It is very important for policymakers in our countries to make informed decisions. And we hope that study that has been developed will provide that information in order for them to make the right decisions for their countries. And certainly the mobilization of domestic resources is crucial, in particular at this time of recovery for COVID-19 and beyond that. And this is a historic decision in many respects. And therefore, we hope that this study will contribute for the right decision for our member countries. The study has covered the members of the South Center and also the members of the African Union. And as will be seen in the study, there is very detailed information about what the impact, the potential impact of these 2 solutions may be. So thank you very much again. And please, I hope you have an excellent discussion.
Maybe I can take it from there. Can we proceed?
Yes, absolutely. You're live.
All right. No, thank you very much. And let me also, thank Dr. Carlos Correa for those opening remarks. Indeed, this being done jointly, and I'm happy to moderate this session. I think Dr. Correa has said it all, why we are here. And I think what I will do will be basically to invite Mr. Abdul Mohit Chaudhry of the South Center, who will make a presentation on this report that was prepared by the consultants that we engaged to look at the impact, revenue impact of the two-pillar solutions. And so without much ado, can I please invite Mr. Chaudhry to make the presentation?
Thank you very much, Your Excellency. It is an honor to make this presentation, really, to showcase the findings of the study. So I hope everyone can see my screen. And there's a great deal of ground to cover, so I'm going to go through fairly quickly. So as mentioned, the objective of the study is to really compare the tax revenues which would come from the OECD and the UN solutions for taxing the digital economy to the member states of the African Union and the South Center. And we would like to begin with an acknowledgement of the authors who really carried out the study for us, Dr. Vladimir Starkov and Mrs. Alexis Jin, who are with NERA Economic Consulting, who responded to the call for papers which was put out by the Coalition for Dialogue on Africa and the South Center, and really carried out this very detailed study for us. So the study, some key aspects of the study are, it's first of all preliminary. So this will be the world's first ever revenue estimates of Article 12B. This is the first time in the world that we have such data, especially at a country level. And this is also the first time in the world that there is some such data for amount A at such a scale. So the study provides this data for 84 countries, which is the combined membership of the African Union and the South Center. And the data, it must be said, is also, these estimates are conservative. It's conservative because the revenue from amount A, which is the OECD solution, is most likely going to be smaller than this study contains, because as this event is going on, the model rules for Pillar 1 are still being released, they're still being finalized. But what we can see so far is that it's quite clear that the number of companies which will be covered by the OECD solution and the amount of tax which they will pay both are going to reduce. And I have put a link to the South Center's tax initiative website, which provides details of the South Center submissions on the OECD rules. And these detail as to how the rules are going to result in a lesser amount of tax for developing countries. Another point is to note that the revenues from Article 12B, which is the UN solution, are going to be even higher than is estimated in our study, because Article 12B doesn't have a threshold, unlike the OECD solution. So even if it doesn't matter what the amount is, even if it's a very small amount, even if it's like a $2 transaction, it would be covered. But that means that any company can potentially come in scope. So to keep the study manageable, we used a threshold of 750 million euros, which is arbitrary, so that the number of companies in the scope of the study would be kept at a manageable level. So if that scope is reduced to zero, the revenues from the UN solution will be even higher than is shown in our study. A few points about Article 12B, which is the UN solution again. So Article 12B has two solutions. One is the gross method, and the gross method can be simply understood as a digital service tax with the benefits of a tax treaty. So there is a way to resolve the double taxation problem that comes up. So that is how the gross method can be understood. It's a withholding tax on each payment, and that's it. So it's a tax on revenues. It's not a tax on profits, just like a digital service tax. The net method, on the other hand, uses a simple formula which is applied to the local revenues which the company makes from the jurisdiction to determine what the profits are. And to this amount, the country's domestic corporate income tax rate is applied. So these are the two solutions under Article 12B, which can be used. And the study provides different results, assuming a narrow scope and a broad scope. So a narrow scope means that the companies which will be covered by Article 12B will be the so-called pure automated digital service companies. So Article 12B is a tax on income from automated digital services. And these are defined in paragraph 6 of the article, which covers the classical services like income from online advertisement, income from search engines, income from social media, intermediation platforms like Amazon and so on. But this is a narrow scope. If the scope is broadened to include hybrid companies such as telecom companies, finance companies, companies which have traditional retail, but also now sell these goods and services online, e-commerce plus traditional retail companies, then that is a broad scope. So we provide revenue estimates for both a narrow scope and a broad scope. And just for reference, because the presentation will be shared with all the registered participants, the link to the latest version of the UN Model Tax Convention is also provided. And finally, this presentation will cover one, which countries are going to redistribute amount A, because the OECD solution of amount A is a redistribution of taxing rights. So that means some countries are going to have to give up their taxing rights, which will be the developed countries. So the first and most important question is, which are these countries? Because unless they give up the taxing right, nobody else will get the taxing right. And the problem of double taxation will continue. Second question is, how many companies are covered under Article 12B? We have data for that as well. And most importantly, where are these companies headquartered? Because that depends who you sign the tax treaty with or whom you renegotiate the tax treaty with. And finally, we look at the revenue estimates for the three global south regions of Africa, Asia, and Latin America and the Caribbean. We look at all the data for all of the G20 countries, which are members of the South Center and the African Union. And then we will look at an assorted set of countries. So with this, let's begin. And first aspect is, who will redistribute amount A? So again, this means which are the developed countries which are going to cede the tax base, which are going to give up the taxing right and redistribute that to the developing countries. So this looks at first the number of companies which are in scope. And here we see that if the 20 billion sales threshold is used for the OECD solution of amount A, around 37 companies come from the United States alone, out of a total of 76 companies. So about half of the companies which will be paying the tax under the OECD solution are American companies. So American partnership or the American ratification of the OECD solution is essential for it to work, because half of the revenue is really coming from American companies. Then we see Japan, the UK, China, Switzerland, France, and these countries also have not such a large number, but a significant number of companies in scope. So these are basically the countries who are going to redistribute the tax base under amount A, whose ratification of Pillar 1 becomes crucial. If the sales threshold is reduced to 10 billion, then a larger number of countries enter the picture. So here we see a total of 154 companies which will enter the scope if the threshold is reduced to 10 billion. And again, about half of them come from the US, 70. So once again, the critical role of the US in ratifying the Pillar 1 multilateral convention is very clear. Then we see that Japan, the UK, Germany are other countries which have a large number of in-scope companies, and their partnership is also quite important. Then we come to the amount of money which will be redistributed. So under amount A, basically a certain portion of the profit is redistributed. So the profit is divided into routine and residual, and 25% of residual profits is then the tax base which is redistributed to developing countries. So the reallocable residual profit is 25% of residual profit, which is what is the amount which is then redistributed. So again, we see in practical numbers, that means that from the 37, so the US has 37 companies in scope, and these companies will be redistributing 60.6 billion, which is around 54.6% of the total. So even concretely, we see that half of the profits which are going to be taxed are going to come from American companies. Then the second largest amount of profits will come from Japanese companies at 10.8 billion, which is 9.8% of the total. Then from Chinese companies, which of course includes Taiwanese and Hong Kong companies. And then from the UK, we see 9 companies in scope with 7.5 billion and so on. All of this data is there in our paper, which will be released after this presentation. So with this, we come to the first recommendation for developing countries, which is to wait until all of these countries, especially the US, have ratified Pillar 1, not just signed, but ratified Pillar 1 before even thinking about signing, because these are the countries who are going to give the money. So unless they are ready and have legally committed themselves to give the money, there is no point in even considering signing Pillar 1. Then we come to Article 12B. So first question is, how many companies will come under the scope of Article 12B? And if we apply the arbitrary threshold of 750 million, we see that the so-called pure ADS companies, for publicly listed companies, which are companies on the stock market, there are 69 companies in scope. And then if you look at companies which are private, which means not listed on the stock market, there are 15 companies for a total of 84 companies. And if the scope includes hybrid companies such as telecom, finance, and so on, that increases to 187 on the stock market, and then private companies are 34 for a total of 221. So that gives us a total of 305 companies which would come into the scope of Article 12B, applying the arbitrary threshold of 750 million euros. Then the second question is, what do these companies do? So we can see that the majority of them are really in the financial sector. And this raises questions about the design of Amount A, because the OECD solution basically excludes all the financial companies from its scope. So really a large number of, a big sector will be out of scope of the OECD solution, which can be captured by the UN solution. Then we see that there are many from telecom, software, B2B, online search engines, and so on. So these are the sectoral distribution of the companies in scope of Article 12B. And coming to where they're headquartered. So we see that out of 305 total companies, once again, about half of them are American companies, 144 are based in the US, followed by Canada, China, Japan, UK, and France. So these are the countries with whom developing countries may have to consider signing or modifying tax treaties if they want to implement Article 12B. But of course, they are free to do unilateral measures. That is completely their sovereign taxing right. So the second recommendation for developing countries is that Article 12B is better with a broad scope, which includes hybrid ADS, because that would increase the number of companies covered. And as we will see shortly, this makes a big amount of difference to the revenue that will come into their, that they will collect. Now coming to the results, which is what we've been waiting for. So this looks a little wonkish, so I will just take you through it bit by bit. So these are the results for Amount A versus Article 12B for the member states of the South Center. So what this essentially means is that in the year 2020, this is the amount of revenue that will come from Amount A, which is the OECD solution, and the rest will come from the UN solution. So this dark blue is the amount that will come from Article 12B's gross method with a 3% rate, and this is the revenue that will come from the gross method with a 4% rate. And this green is the revenue that will come from the net method. So this means that 4.9 billion is the amount of tax revenue South Center member states will collect in 2020 if the threshold is set at 20 billion euros. If the threshold is lowered to 10 billion euros, then they will collect 5.5 billion. If they apply the gross basis method with a 3% rate, they will collect 3 billion with a narrow scope of only pure ADS companies. But if the scope is expanded to include hybrid companies as well, then that will increase to 8.6 billion. Again, if the gross method with a 4% rate is used, then South Center member states will collect 4 billion in 2020 with a narrow scope. And if a broad scope is used, then they will collect 11.4 billion. And similarly, if the net method is applied of Article 12B, then they will collect 2 billion with a narrow scope in 2020 and 4.2 billion with a broad scope in 2020. So from a purely revenue standpoint, we can see, and for the rest of the study, we are going to compare the revenues which are received here with a 20 billion threshold, because it's not clear if the threshold will ever be reduced to 10 billion, because that depends on a whole set of factors on a review and so on. So it's not automatic. So the fair comparison would be looking at the revenue from here with a 20 billion threshold and comparing it with the revenues with a broad scope, because Article 12B's paragraph 6 is only indicative. It doesn't say that only these companies will be ADS companies. It says that these must include these companies, but it can include any other set of companies as is defined in the treaty negotiations and in the domestic law. So the scope of Article 12B is essentially a broad scope. So the right comparison is 4.9 billion with 8.6 billion, 11.4 billion, and 4.2 billion. And from a revenue standpoint, it is absolutely clear that the best option for South Center member states is the UN option of the gross method with a 4% tax rate, which will give them 11.4 billion in 2020. So this was our summary for the South Center, and we will next look at the African Union. For the African Union member states, we see that in 2020, they will get 0.5 billion from the OECD solution 1 billion, almost double, exactly double, in fact, from the UN solution with a 3% rate, and almost triple 1.4 billion from the UN solution with a 4% rate. And even with the net method, they will get a higher revenue of 0.7 billion. So again, for the member states of the African Union, it's very clear that from a revenue standpoint, the best option for them is the UN solution with a 4% tax rate. Now looking at regions. So if we look at sub-Saharan Africa, excluding Nigeria and South Africa, and we look at these two countries individually, for sub-Saharan Africa, from the OECD solution, they're getting 105 million in 2020, and 4 times that from the UN solution. From the UN solution, they're getting 408 million, 4-fold increase, and almost 5 times, more than 5 times, in fact, with a 4% tax rate of 545 million. And even from the net basis method, they are getting 242 million, which is twice what they're getting from the OECD solution. So again, from a revenue standpoint, for sub-Saharan Africa, the UN solution with a 4% tax rate is the best option. Looking at Central Africa, we see the same story. From the OECD solution, they're going to get only 35 million, whereas from the UN solution, they will get more than triple at 111 million with a 3% rate and 148 million with a 4% rate. And with the net method, they will get 79 million, which is more than double. Looking at Western Africa, excluding Nigeria and Senegal, for a total of 13 countries, from the OECD solution, this region is getting 44 million, and a significantly higher revenue estimate comes from the UN solution with 3% rate of 263 million, 351 million with a 4% rate, and 157 million from the net method. So again, from a revenue standpoint, the choice is clear, the gross method with a 4% rate. For East Africa, we see the same story. From the OECD solution, they're getting 88 million. From the UN solution with a 3% rate, 246 million, and with a 4% rate, 329 million. And with the net method, it's 152 million. So once again, the conclusion is obvious, and this will actually continue. So in North Africa, excluding Egypt and Morocco, which is for 5 countries, we see from the OECD solution, they're getting 46 million. From the UN solution, they're getting 139 million with a 3% rate, and with a 4% rate, that's 186 million. And even with the net method, they're getting a much higher revenue estimate of 67 million. For Southern Africa, excluding South Africa, for a total of 9 countries, from the OECD solution, it's 43 million. From the UN solution with a 3% rate, it's 94 million, and with a 4% rate, it's 126 million. And with the net method, it's 59 million. So once again, from the revenue standpoint, the UN solution with 4% rate is the best option.
Could you please try to slow down the path, please, for the interpretation? Thank you.
Yeah. Coming to individual countries. Now for Nigeria, we see that for 2020, from the OECD solution, it's 91 million. And from the UN solution, it's almost triple. It's 278 million from with a 3% rate. And it's close to 4 times with 371 million with a 4% rate. And with the net method as well, it's 163 million. For Kenya, we see a similar story. With the OECD solution, they're getting 25.5 million. With the UN solution with the 3% rate, it's 56.1 million, and with a 4% rate, it's 74.8 million. And with the net method, it's 36.2 million. For Egypt, from the OECD solution, it's 43 million. And from the UN solution, it's really much higher, actually. As is the case for most countries, it's 219 million with a 3% rate and 292 million with a 4% rate. And even the net method gives close to double at 79 million. For the Democratic Republic of Congo, from the OECD solution, it's 14.2 million. From the UN solution with the 3% rate, it's 43 million, almost 4 times. And with the UN solution with a 4% rate, it's 57.5 million. And even the net method gives 32.3 million, which is almost double. For Tanzania, it's the OECD solution is 15.8 million, and with the UN with the 3% rate, it's 53.7, and with the 4% rate, it's 71.7 million, and even the net method gives 34.3. For Ethiopia, from the OECD solution, it's 23.8 million. From the UN solution, it's double, 50.9. With the 3% rate, with the 4% rate, it's 67.9. And with the net method, it's 32.5. For Malawi, from the OECD solution, it's 0.9 million. From the UN solution, it's almost triple, 2.8 million, and almost 4 times at 3.7 million with the 4% rate. And even with the net method, it's double, 1.8. And these are really countries for whom every $1 million makes a very big difference. For Zambia, from the OECD solution, it's 6.2 million. From the UN solution, it's 15 million. With the 4% rate, it increases to 20 million. And with the net method, it's 10 million. For Cameroon, from the OECD solution, it's 10.3 million. With the UN 3% rate, it's 33.9, 3 times, more than 3 times. And if the rate is increased to 4%, it's 4 times, more than 4 times, actually 45.2 million. And even the net method gives double the revenues at 22.10. For Burkina Faso, it's 3.7 from the OECD, 13.6 from the UN with a 3% rate, and 18.2 million with a 4% rate, and 9.3 with the net method. For Namibia, the results are actually not that different from the OECD solution. It's 3.3. It marginally increases to 3.7 with a 3% rate, and a little more to 4.9 with a 4% rate. And the lowest actually comes from the net method of the UN of the UN solution. For Chad, we see that OECD it's 2.2. From the UN with the 3% rate, it's 7.9. With a 4% rate, it's 10.5, and with the net method, it's 6.7. For Cote d'Ivoire, from the OECD solution, it's 12.4, and almost 6 times. It's 70.6 with a 3% rate. It's 94.1 with a 4% rate, and 38.3 with the net method. For Ghana, it's 13.5 from the OECD solution. And again, almost 6 times, 75.3 with a 3% rate from the UN. And if that's increased to 4%, it goes up to 100 million. And from the net method, it's 33.9 million. For Algeria, it's 34.7 from the OECD, 96.7, almost triple from the UN with a 3% rate, and 128.9, almost quadruple with a 4% rate, and 46 from the net method. For Tunisia, it's 6.8 from the OECD solution, 22.5 with the UN solution 3% rate, increase a bit to 30 million with a 4% rate, and 12.2%, which is still double from the net method. Coming to Morocco, we see that it's a bit different. They seem to be benefiting almost as much from both the OECD and the UN solutions. So the OECD solutions give them 28.6. And in fact, if the threshold is reduced to 10 million, they seem to benefit more from the OECD solution. But if just the 20 billion threshold is compared, then they get more revenues from the 4% gross basis method, which will give them 39.7 million. For South Africa, we see that they're actually going to clearly benefit from the OECD solution. So they will get 72 million with the 20 billion threshold. And if that's reduced to 10 billion, they will get 82 million. And both the gross and net basis method will actually deprive them of revenues. And the 3 and 4% rate of the gross method will reduce their revenues, whereas the net method will give them 32 million. So for South Africa, in fact, the OECD solution seems from a revenue standpoint, the better option. We see a similar story for Senegal, which seems to benefit in terms of revenue, primarily from the 4% UN solution, which will give them 8.1. But the next best option is the OECD solution, which will give them 5.9. Now coming to Asia. For East Asia and the Pacific, excluding China and Indonesia, which are 6 countries, the region as a whole will get 267 million from the OECD solution, and almost 3 times, more than 3 times actually, from the UN solution with the 3% rate at 647 million, and almost this is double, and this is almost triple at 862 million from a 4% rate, and 323 million from the net basis method. For South Asia, we see a similar story, excluding India, which is basically Sri Lanka and Pakistan. We are seeing 79 million from the OECD solution, 215 million from the 3% UN solution, and 287 million from the 4% UN solution, and 105 million from the net method. So overall, both for East Asia and the Pacific, excluding China and Indonesia, and for South Asia, the UN solution with the 4% rate seems to be the best option. Coming to individual countries, for India, we see that from the OECD solution, they are expected to get 0.27 billion. And from the UN solution with the 3% rate, that will basically triple to 0.75 billion. And that will increase by 4 times to 1 billion if the 4% rate is used. And even if the net method is used, that will still give them more revenues at 0.41 billion. So for India, the option seems to be clear that the gross method with the 4% rate from a purely revenue standpoint is the best option. China, which is a capital exporting country, will actually be affected in any case by all the solutions involved because they have to cede some of their tax base. So from the OECD solution, they will get 2.6 billion. But even then, they will gain from the UN solution more. So with the 3% rate, they will get 3.1 billion. And with the 4% rate, they will get 4.1 billion. And even the lowest revenues will come from the net method, which will be 1.4 billion. For Indonesia, the difference is quite staggering, as it is for many of the other countries in the study. From the OECD solution, they will get 239 million. From the UN solution, they will get 734 million with a 3% rate, 979 million with a 4% rate, and 296 million with the net method. For Sri Lanka, which is one of the countries which refused the two-pillar solution from the OECD solution, they will get 29.5 million. From the UN solution with a 3% rate, they will get more than double, 78.4, and with a 4% rate, they will get more than triple at 104.5 million. And even with the net basis method, they will still get a higher amount of tax revenue. For Pakistan, which is another country which rejected Pillar 1 and Pillar 2, from the OECD solution, they will get 49.3 million. From the UN solution with a 3% rate, they will get 136.9 million, which is really a big difference. And with a 4% rate, that will increase even further to 182.5 million. And even with the net method, they will still get a higher amount of revenue at 71.9 million. For Malaysia, from the OECD solution, they will get 82.9 million. From the UN solution with a 3% rate, they will get 141.9 million. And with a 4% rate, that will increase to 189.2 million. And even with the net method, they will still get a higher amount of revenue at 105.8 million. Now, coming lastly to Latin America and the Caribbean, for the region as a whole, from the OECD solution, they will get 212 million. From the UN solution with a 3% rate, they will get more than 3 times at 646 million, and more than 4 times at 862 million with a 4% rate. And even with the net method, they will still get 362 million, which is higher than what they will get from the OECD solution. So from a revenue standpoint for Latin America and the Caribbean, excluding Brazil and Barbados, from a revenue standpoint, the best option is clearly the gross basis method with a 4% tax rate. Coming to Brazil, they really seem to gain very little from amount A. They will get 0.5 billion, which seems to remain the same even if the threshold drops. So there is no benefit in the future for them. Whereas from the UN solution, they will get 1.3 billion, which is almost 3 times the revenue with a 3% rate. And if that is increased to 4%, they will get more than 1.7 billion. And even with the net method, they will still gain more revenues from the UN solution overall. The same applies for Argentina. From the OECD solution, they will get 95.7 million. If the UN solution is used, they will get 260.3 million with a 3% rate. If it's increased to 4%, they will get more than 3 times, 347.1 million. And even from the net method, 138.7 million is still higher than what they would get from the OECD solution. For Bolivia, From the OECD solution, they will get 8.7 million. From the UN solution, 3% rate, 32.7 million. With a 4% rate, 43.7 million. And with the net method, 14.6 million. So again, from the revenue standpoint, the choice is clear. And lastly, I think for Venezuela, they will get 19 million from the 20 billion threshold. But if that is reduced to 10 billion, then the revenue improves significantly to 22.3. But that is still less than what they would get from the UN solution of 26.6 with a 3% rate and 35.5 million from a 4% rate and 20 million from the net method. So overall, Venezuela would still benefit by going ahead with the gross method with a 4% rate. So with that, we come to the end of our revenue estimates. There are a total of 84 countries, which you are welcome to explore in our study, which will be published now. So please check the chat. And the study should now be available for everyone to access and explore. But just a few concluding points from the presentation. So it's very clear that the overwhelming majority of developing countries gain about 3 to 4 times revenue from Article 12B's gross basis method with a 4% rate and a broad scope, which includes hybrid ADS companies. To repeat, the gross basis method is a digital service tax with tax treaty benefits. The OECD solution of amount A appears to be of minimal benefit to developing countries. In fact, it pales in comparison before the UN solution of Article 12B. And developing countries should in any case wait until the US, UK, Japan, France, Germany, Switzerland, Ireland, and other countries which are redistributing amount A ratify Pillar 1 before even thinking of signing the agreement. And the last slide, developing countries who do not have a tax treaty with countries where the companies in scope of Article 12B and amount A, and they, as you can see, are a similar set of countries, are headquartered. These countries have an advantage. If you don't have a tax treaty, it's an advantage. These countries can and should introduce digital service taxes or other unilateral measures to really tap into the large amount of revenue that they can collect. And if the headquarter country wants to avoid double taxation on its residents, then Article 12B provides a fair treaty-based solution which has come from the United Nations. The net basis method of Article 12B seems to provide limited revenues, so it is better to exclude that as an option during treaty negotiations. And during treaty negotiations, it is recommended that paragraph 6 of Article 12B include the broad scope, which includes hybrid ADS companies, so that it will benefit the developing countries. Thank you very much.
Thank you very much, Mr. Chandre, for that presentation. I think very informative. You've done it so well. I mean, as if you are one of the authors there. Very, very much impressive for a very technical paper. I think what we are seeing is that, yes, the UN solution seems to be providing, to be better than the OECD solution for most of our regions as well as countries. But obviously, there might be some, questions that will be posed, and I will give you that opportunity to respond to the questions that would be posed. But before we do that, I would like to invite Her Excellency Gautam Silva, who is the ambassador of Sri Lanka to the WTO, to also make an intervention. And after that, I will open the floor for any questions that we may have or comments. So, Your Excellency, Ambassador Silva, you have the floor, please. But please, thank you so much, Mr. Chaudhry, for that very good presentation.
Yes, thank you very much, distinguished excellencies and panelists. I hope I'm loud and clear. Hello, am I loud and clear?
Yes, I think you are on my side. I don't know about the others, but you're very loud.
Right. Thank you so much. At the outset, let me first thank the organizers of this dialogue, the South Center, Dr. Correa and his team, and also the Coalition for Dialogue on Africa, for inviting Sri Lanka to participate at this event as a panelist, particularly to discuss the implications of this comparative data on the tax revenue to be potentially generated by the two alternate solutions and the way forward for developing countries. The overview and very detailed and comprehensive presentation made by Abdul of the South Center is very pertinent. And as Honorable Minister stated, it actually is very useful in making many of our decisions making, and including my deliberations today from the perspective of Sri Lanka. It is now a fact of life that developing countries are facing major debt distress. As you are aware, Sri Lanka has attracted the center of this discussion in recent times. As it is well known, the COVID and the economic crisis and other developments that are now we are witnessing have also caused regress in attaining the Sustainable Development Goals. This is a very serious matter. I think all countries are asking the question from themselves, how do we really achieve the Sustainable Development Goals by 2030? We may need to really revisit some of our targets in the dates to come. In addition, we also see the official development assistance inflows not near adequate and may reduce even past Ukraine war period, as Western countries are now prioritizing the support to Ukraine in its rebuilding efforts, and also assisting the refugees that are flowing into their countries. While investment flows have increased post-2020, but how private investment in infrastructure, particularly in developing countries and LDCs, remain low relative to their historical averages. Quite disturbing also the slowing growth, slowing global GDP growth that also implies reduced demand. This combined with the high corporate debt can mean reduced investment in the future. Now, a corporate debt in emerging markets and developing economies has, on average, risen from about 60% of the GDP in 2006 to about 8% of GDP in 2019. And the pandemic may have further increased this level as companies have sought debt deferrals. A negative effect of debt on future investment is expected to be more pronounced for larger and highly leveraged firms. Thus, the tax collection, particularly the indirect form of direct tax collection, remains the key source of financing for developing countries in the medium term to overcome the COVID and economic and also the food crisis that are impacting these economies. Data reveals that developing countries have a low tax GDP ratio, typically ranging below 10 to 15%, which is not even half of the average of our OECD countries of 33.5%. Now, developing countries are mostly dependent on corporate income tax revenue, while developed countries who have richer citizens rely more on personal income taxes. For an example, in Sri Lanka, the standard corporate tax income rate was reduced from 28% to 24%, effective from January 1, 2020. I think, as you know, this has been cited by the IMF and other advocacy agencies to be one of the causes of the current crisis that Sri Lanka is facing. Gains and profits from information technology and enabled services have been exempted from income tax. So that is a key concern for Sri Lanka. Again, while a concessionary tax rate of 14% was granted to construction sector and healthcare. And again, the concessionary tax rate of 18% was granted to the manufacturing sector. However, considering the revenue impact of the above reforms, certain new proposals are now being presented to the government to increase its standard the corporate income tax rate from 24% to 30%, and increasing even the concessionary rates from 14 to 15%. which would be made effective from 1st October 2022. While the economy becoming increasingly digitalized, that is, I'm referring to the developing country economies, more and more companies are conducting their business online. Thus, the OECD reform is historic, and as it tries to address this new reality, which we also have to capitalize on. However, the revenue estimates clearly show that the revenue generated by amount A is insignificant for developing countries' needs. In case of Sri Lanka, it is anticipated that the tax reforms would make Sri Lanka's cooperative income tax rate in conformity with the inclusive framework led by the OECD, which includes a global minimum CIT rate of 15%, applicable to the global profits of large multinational corporations. However, this needs to be revisited in light of the UN option, which clearly shows that the revenue generated by amount A under OECD model is insignificant for developing countries' needs. So the Sri Lanka will have more room to impose high income tax rates, also covering the gains and profits from the information technology and enable services, which have still been exempted from the income tax. This is especially troubling as agreeing to the OECD solution implies giving up our unilateral measures on all out of scope companies. Pillar 1 has a very high threshold of euro 20 billion, which applies to less than 100 companies. So that means all the remaining companies' revenue will be effectively untaxed by the developing countries, which is completely and grossly unfair. The revenues available from Article 12B is gross basis method are far more suitable for developing countries like Sri Lanka for meeting their revenue requirements, which is not embracing very robust and drastic tax reforms, and can be seen on average, they provide at least 2 to 3 times the revenues from that they can derive from amount A. Agreeing to Pillar 1 thus means developing countries will have to permanently give up their taxing rights on a very significant portion of modern economy at a time when they are in the middle of a historic economic crisis, coupled with the food crisis, in a dire need of funds. Article 12B is a solution of the United Nations and perfectly in line with international law. That is precisely the reason that Sri Lanka is willing to embrace this mechanism. It is a far more legitimate alternate solution for developing countries, as it provides them with more revenues and has also come out of a genuinely universal institution, the UN, rather than the inclusive framework, which is accountable only to a limited number of countries. Countries such as Sri Lanka, which have chosen not to agree to Pillar 1, should not have to face pressure or arm twisting. This is the biggest challenge that we may have to face eventually, particularly renegotiation of the tax treaties wherever it is required. So the South-South cooperation and solidarity is needed from other countries who similarly choose not to go with the OECD solution. I stop here. I think we have time in order for our moderator to give more adequate time to open the floor for questions. So I'll stop here, but I'm more than willing to answer any questions if any panelist or any participant would have. Thank you so much for the opportunity.
Thank you very much, Excellency, for that intervention. Again, providing us with information relating to some of the challenges that our countries are facing, and in particular also Sri Lanka, but also looking at how you find it in Sri Lanka that the UN solution is also better. than the OECD, solution. And obviously, also proposing that we also look at working together so that we can all focus on the UN solution, which seems to be much better in terms of the revenues than the OECD solution. Yes, I think the issues that you highlighted, in terms of what Sri Lanka faces, also what we face in these other countries. And clearly we need to raise more revenues. And as we raise more revenues, comparing the two solutions indeed is what we should be doing, and obviously opting for the one that gives us more revenues than the other one. Of course, there might be other considerations that we may need to take into account, but on a revenue basis, we clearly seem to be on the same page. Thank you so much, Your Excellency, for that intervention, which also gives us insights into the Sri Lankan experience. Excellencies, ladies and gentlemen, we would want to take maybe just a few questions or comments. Time is running up. We only had 55 minutes for this particular session. So please, in case you have any questions or comments, observations, try to make them as short as possible. Who would like to take the floor? Anyone wanting to take the floor, please?
Excellency, there is only one, sorry.
Yeah, I've seen this.
Yes, there is only one question in the chat.
There's one question.
For Abdul only, yes.
Yes, I've seen that question. I think it says, okay, so the question is actually to Abdul, our presenter, Mr. Chaudhry. So the question is, how have these assessments been calculated? Is this the question that you're referring to, ED? And then I also see there's a question here. I would like to hear of the conditions, assumptions to make the revenue not realizable in Africa. This is coming from Mr. Abiodun Adegboy. Abdul, would you like to respond to these questions?
Yes, Your Excellency, and my sincere gratitude also to the Ambassador of Sri Lanka for her comments. I will just make my response very short. So I would encourage the first question on how have the assessments been calculated to read the paper, because that provides a detailed answer, which is too broad to go into right now. And for the second question about the conditions and the assumptions to make the revenue not realizable in Africa. Since only a very, very small portion of the MNE's profit is being redistributed to developing countries, that is the basic answer as to why African countries specifically will gain less from the OECD solution and more from the UN solution, simply because the UN solution applies to a larger slice of profits. That's the short answer.
For that response, we have another question. Actually, this one relates to why, South Africa and Namibia seem to be benefiting more from the OECD solution than the UN solution. Would you have some explanations, some reasons for that? Thank you.
Thank you, Excellency. But I see the ambassador also has a hand up. Maybe I would prefer to go after her.
All right.
Yes.
Excellency.
Yes, yes, Honorable Minister.
Question?
Yes.
Yes.
No, it's a question, I think, to Abdul. Particularly, I think in my intervention, I indicated that renegotiation of some of these treaties, bilateral taxation treaties, going to be a daunting task for many developing countries such as us. I think these were signed anticipating a lot of investment and so many other benefits. But I think in the current context, we certainly need to revisit these agreements. So whether a South Center or any other, I think even the the CDA would be really conducting such capacity building, initiatives to empower and train our negotiators who are going to engage in such activities in the future. And particularly, I think the center and other affiliated organizations are doing a wonderful job. I think I myself, though I was a tax officer before, I was an assessor before I joined this commercial diplomatic service, but I was not dealing with corporate tax to a large extent. But I found the subject is very technical, where you need a lot of experience and understanding of the concepts. So I think thanks to the center's dissemination exercise efforts that I really could refresh my memory, and I also have gathered a lot of knowledge, though I'm not fully an expert on this subject, but certainly I see a lot of value in that. So coming to my question, so whether center and other affiliated organizations are planning to sort of commence such technical assistant programs for our delegates, our negotiators to get familiar with these concepts, and particularly sort of work on certain model law treaty, because you need to bring in certain amendments to your treaty. So whether you will be developing such model articles that could be quite replicated, or they can certainly get influence over it, and then reshape their articles in a manner that protects their rights and obligations. So I hope that those are some of the things that the center and the affiliated organizations can certainly do in the future. Thank you very much for the opportunity. Sorry.
No, thank you very much, Ambassador, for those questions. So, Mr. Chaudhry, so you still have the floor to respond to that question to do with why Namibia and South Africa seem to be benefiting more from the OECD solution than the UN solution. But again, I think maybe the ED for CODA, Mrs. Wad Osman, but also Dr. Correa may want to take up the question on capacity building that has been raised by Her Excellency Gotham Silva. And then we will close after that. Thank you.
Thank you, Excellency. So on the question of South Africa specifically, it's because South Africa is actually hosting some of the multinationals, so it would have to cede some of its tax base under Amount A. That's why the revenue estimates are like that. And for Namibia, I'm not particularly sure. And the authors of the study, Starkov, Mr. Starkov and Mrs. Jin are over here. And of course, we would be happy to continue this discussion later on to see on an individual country basis why the revenue estimates are the way they are. But yeah, that was my short answer to the question.
Thank you very much for that response. Could I invite maybe Mrs. Osman? Would you like to say anything pertaining to the issue of capacity building?
Thank you, Excellency. Well, in the context of the work of the high-level panel on illicit financial flows, which is the reason why we have been collaborating with the South Center for these series of 2 dialogues. The last one was in December 2021, right in the wake of, right after these. We were told that more than 130 countries signed a multilaterally agreed text, which when we looked at it carefully seemed by design not to have been all that an inclusive process. We will be going as the Secretariat of the High-Level Panel in 22 African countries between 2022, 2023 and early 2024. And this question, country by country, is going to be looked at. Abdul, in the case of Namibia, is one of the countries where a lot of effort are going to be deployed, both by a set of United Nations organization, UNECA, UNCTAD and OECD, They have a project to measure illicit financial flows. There is a lot going on. It's a mixed bag there, but there is a lot of things that we needed to unpack, not only on this front, but on many others. So Excellency, you are leading actually that work on behalf of the high-level panel. I think that we are going to determine exactly, and this time around, unlike what we have been told, the ideas and the capacity building programs will actually have to be formulated by the countries themselves. And the idea is that the panel, African Development Bank and Afro-Exim Bank, availed substantial resources for the panel and the panel secretariat to capacitate them and to do and handle this matter. I am pleased to see one of our panel member, Raymond Baker, who will be speaking later. Yes, we're not really that pressured by the OECD deal as far as we are concerned. And for sure, as you said, Excellency, it's going to be, we will be capacitating our countries to follow what will transpire from a normal and real multilateral setting like the UN. Thank you very much.
Your Excellency, if I may just quickly make a comment, the Sri Lankan ambassador has to leave for a very important negotiation in the WTO, so if she could kindly be.
It is the indirect taxation of e-commerce moratorium, e-commerce moratorium and work program on e-commerce. So we are again trying to, sort of seek some because we are not collecting custom duties on electronic transmission. So it has been a moratorium. There has been a moratorium since 1998. So it's been renewed every 2 years. So now we are just around the corner of the ministerial conference. So today is we are having consultations. So please excuse me for that. So I had to also represent my country, and I really value this opportunity. Thank you, and all the very best for all the things. Honorable Minister and dear colleagues and distinguished panelists, thank you. Thank you. It's a pleasure and a privilege. Yeah.
Thank you very much, Your Excellency, for your time. Thank you very much for your intervention, sharing with us the information that you had. We really appreciate and wish you all the best where you're going for the next meeting. Please, you have a bye-bye.
Thank you. Bye.
All right. So, Dr. Correa, would you like to say anything on capacity building, and then we can close this? Or Abdul, that's fine.
Yeah, if Dr. Correa is still on the call.
But I still have a lot of questions here, so I don't know how we're going to deal with them.
Yes.
Yes.
Is actually
yes, sir, please.
Side. But then maybe since the questions are here, is it fine if
Here.
some of these questions?
Yes, please.
Yeah. So I think there is a question here from Tatenda Nyachega, and I can just read it out. Given the results from the study where the greater percentage showed that the UN solutions are more favorable than the OECD solution, the quick question would be, are there any country-specific conditions which favor the UN solution to the OECD solution? That is question. And then we can also take another question. This is from Murad Bukadom, and calling, this is from Algeria, and then obviously thanking the panelists. But then the question is, that the expected revenues, whether from the UN solution or OECD solution, is commensurate with the market size of the hosting country. And then it says, am I right? And then the other question actually is going to Ambassador Silva, who has left. So probably maybe it can be taken up, but it says, what are the types of pressures anticipated against Sri Lanka for rejecting the BEPS deal, in what form and from what sources? So probably the ambassador would have been in a much better position to respond to this, so we'll leave this one. And then maybe as author of the study, so this is actually from the author who says, I can address the question about the benefits to South Africa. So we'll give the author to give us that response. So in that case, then let me start with the author, and then we can take up the other questions. And then Dr. Correa, you're already here. So I'll start with Dr. Correa, and then we'll come to Mr. Starkov, and then I'll ask Abdul to respond to the other questions, and then we close it. Thank you very much.
Well, thank you for the question, and thanks again for the excellent presentations. I think this webinar is giving very important information, as was mentioned before, for policymakers to make the right decisions right now in connection with the two-pillar solution or alternative solution that may be applied in different countries, South Center members and the members of the African Union. So regarding the first question, I think this will require further analysis in order to identify any specific characteristics of the countries that are subject to the study, in order to find some rationale for the differences that are presented in the study in relation to the impact of the two alternatives. So maybe Abdul can elaborate further on this, but I guess that these country-specific characteristics may need to be identified with further research. The second question actually makes reference to one of such characteristics, which is the market size. That may be the explanation for the differences in the impact of these two alternatives. So that's one possible reply to this. But I think that further research will be needed in order to on a safe basis, on a robust basis, to give a reply to the first question. We cannot certainly reply to the third question. So the ambassador was a better place to do that, certainly. But we can expect that this is happening, that pressures have been put on countries which have not adhered or have already expressed that they are not following the approach of adhering to the two-pillar solution. And perhaps it would be good to hear the author.
Yes, thank you. So let's hear from the author, Mr. Starkov.
Yes, hello. Yes, thank you so much for inviting me to this forum as an author. It's an honor to speak to this audience. In fact, I would be brief, given that we have a short format of the presentation. I'd like to commend all the speakers, in particular Abdul, for presenting our study. It is quite a lengthy document, and I encourage everyone to read it to get the answers to the questions. I would only highlight a couple of things here that are important to pay attention to. Is that in our study we considered, or the important factors that would provide the driver behind our results is the composition of the economy of the country. So to give an example of South Africa, it does host significant number of companies that would provide cross-border ADS services. And since the UN Convention implies relief from double taxation, that would mean that South Africa would have to provide this relief in the context of a treaty, and that means ceding some of the benefits. So for that reason, well, on the other hand, for the amount A, the South Africa will not be ceding the revenue. So that's the condition when South Africa stands maybe to benefit more from the amount A than from the 12B. So I hope that covers some of that. And then the other important point is that in our study, we assume the global coverage of the treaty framework for the Article 12B, in fact. So that is a tall task, which I hope groups like this would have to solve. But since the convention is on the bilateral basis, clearly the agreement between the nations that host the MNEs that would provide the revenues is very important. Or perhaps somebody could think about solving this on a multilateral basis to really achieve the results that we've seen in the study.
Thank you very much for that, for those responses. And I would also want to thank you for having prepared this, report, which is the subject of discussion at this forum. I very much appreciate, and please convey the same to co-author. So I think we should now, basically conclude. It's been quite a good, discussion. Would like to thank our panelists, Abdul Chaudhry, who made the presentation on behalf of the authors, but also Her Excellency Gotami Silva, who also made an intervention, which did also focus on Sri Lanka. I would want to also take the opportunity to thank all those that were able to pose questions, provide comments. I know time was limited and not all of us would be able to provide any comments. And I also wish to commend the collaboration between the South Center and the CODA Secretariat in organizing this forum, in actually getting the study undertaken, which will guide our policymakers in taking decision regarding whether to go for the OECD solution or the UN solution. But from the presentation, from the discussion, obviously the UN solution is, should be preferable to our countries, both South Center members, states, as well as the AU member states. The document, as indicated, will be available, I think, also in other languages. And I would invite each and every one of us to spend some time to have a look at it, to understand the analysis that is going in there, and therefore be able also to inform our decision-making at country level. So I would like to close this particular session and thank you all for the time. Thank you all for your participation.
Very much, Excellency. I think Dr. Dipiolu, our next moderator for the second and last session, is online. Dr. Dipiolu, the floor is yours.
Thank you very much, Executive Director Koda. Good afternoon to everybody. Also to the Executive Director of the South Center. Welcome to this session where we'll be looking at alternative measures. And I would say that my instinct about this session is to say that it's all very well for us to look at the presentations on revenue, which are quite illuminating, but there is and always will be in global affairs a political economy dimension. I think it's so this session basically is for us to try and tease out some of the issues that we need to address from the perspective of political economy. Some of the issues, of course, that we will look at would be, will the developed countries, for instance, all come on board, especially with regard to Pillar 1? Will they resort to Pillar 2? If the resort to double taxation agreements using Article 12 be workable in terms of the costs and the requirements, given the spaghetti bowl of DTA agreements all over the world? What are the alternative policy options available to developing countries? And what has been the experience of developing countries that have implemented national measures relating to digital services, taxes, significant economic presence, etc., etc. And to help us get started on this session, we have three panelists with us. We have Ms. Patricia Garcia with us. We have Ms. Dolores Gil Esnau with us, and we have Mr. Raymond Baker with us. The three panelists I will invite to speak for 10 minutes each. The other session has eaten into our time, but we will still try to make good. And then we will take one or two questions or comments or just exchange views, because I think that is what is required at this stage. So if Mrs. Patricia Garcia is ready, may I hand over the floor to her? 10 minutes.
Bueno, ¿qué tal? Buenos días. ¿Cómo están? Bueno, para mí es un honor participar de esta charla y quería agradecer la excelente exposición de South Center. Bueno, por el lado de Argentina se ha optado por, en octubre de 2021, el país se comprometió a seguir la solución global de OCDE, con lo cual por ahora no se han implementado medidas unilaterales, ¿sí? Porque esa era una de las condiciones como para seguir con la solución global. Así que bueno, estamos participando de todas las charlas de OCDE sobre Pilar 1, que bueno, después le voy a dejar a Dolores que ella se va a explayar en los detalles del Pilar 1, de pros y contras. Pero bueno, no hemos implementado ninguna medida alternativa. Todavía, de todas maneras, no están bien especificadas qué se entendería, ¿no?, como medidas unilaterales. Precisamente mañana hay una reunión en OCDE como para ver si hay mayores precisiones en cuanto a esa temática, para ver si las retenciones en la fuente, por ejemplo, se van a entender como una medida unilateral. Pero bueno, todavía eso no está definido. Así que, bueno, no sé, Dolores, si querés dar más detalles de lo que es el Pilar 1, como para exponer cuál es la posición argentina.
Muchas gracias, Patricia. Un saludo a todos. Quería presentarme, soy Dolores Gildesnal, trabajo en la Administración Tributaria de Argentina. Quería agradecer la excelente exposición sobre el informe que preparó el South Center, con la información detallada que contiene ese informe. Creo que hoy Argentina, como muchos países en desarrollo, justamente lo que estaban reclamando en el ámbito de la toma de decisiones para ver cuál es la mejor alternativa para los países, era poder contar con números. Creo que este informe viene a tratar de cubrir un poco el vacío que había en esa área. El informe claramente, del informe resulta claramente que lo que es una alternativa con las limitaciones que tiene, ¿no?, obviamente el informe en su análisis, ¿no?, al no poder contar con la información de cada una de las empresas. Estamos trabajando con información, serían en este caso los contribuyentes, pero bueno, claramente muestra si se quiere, una recaudación mucho más elevada con lo que sería la opción del artículo 12 de Naciones Unidas. Yo creo que dentro que siempre cuando fueron analizadas las alternativas, creo que los países sabían que una solución relacionada con lo que son las retenciones, ¿no?, iba a generar mayor recaudación que lo que podría ser una distribución del monto A, que en esa distribución dependemos mucho de lo que de la generación de ese nexo, ¿no?, de ese derecho tributario en cabeza de cada una de las market jurisdiction, ¿no?, las jurisdicciones de mercado que podrían llegar a alcanzar, ¿no?, y poder hacerse de esa renta. Pero bueno, como les decía, Patricia, Argentina adoptó colaborar, se adhirió a lo que es el compromiso hoy ya con Argentina como miembro del G20 está acompañando esa solución global, pero pensando en una solución global porque, como bien mencionaba Abdul, creo que lo que es importante acá es tener en cuenta es qué países están participando de la solución, ¿no?, porque en definitiva hay países que de alguna manera van a tener que distribuir derechos tributarios. Entonces, frente a las alternativas de los países, creo, y en las negociaciones que se están llevando a cabo, hay que prestar especial atención a eso, a cómo se está llevando adelante esa negociación y dónde está parados los países que tienen que justamente prestar consenso, ¿no? Y ratificar la alternativa, ¿no? Que decidan para poder hacer esta distribución de ingresos. Como vemos del informe, creo que surge claramente que es muy importante cómo Estados Unidos se plante frente a esta solución global, porque tanto como vemos en las empresas que forman parte de la Mount A, así como de aquellos empresas o países, empresas donde están ubicados aquellas donde le aplicarían la retención del 12B, vemos que en una gran mayoría estarían ubicadas en Estados Unidos, y creo que seguía Japón, ¿no? como país. Eso surge claramente del informe. Entonces nos parece importante que dentro de las alternativas que se están evaluando, ¿no? Estar en una posición de compartir una solución global con esos países que tienen que distribuir. Coincido plenamente que es importante poder llegar a una solución donde estos países hayan ratificado previamente el instrumento multilateral que se decida para poder hacer esta base de atribución a los distintos países. Y no es menor ahí, obviamente, que como comentábamos anteriormente, trabajar en lo que es evitar esta doble imposición para los países. Hoy por hoy los países en desarrollo están en desventaja con respecto a lo que es la imposición de este tipo de rentas que en un contexto post-pandemia, ¿no? Donde los países en desarrollo están con una necesidad, inclusive Argentina, con una necesidad de recaudación, de ingresos fiscales para hacer frente a sus obligaciones y deudas, creo que están con una necesidad de poder alcanzar esta renta, ¿no? Desde ya, hoy por hoy el compromiso político es acompañar una solución global para evitar la proliferación, ¿no? De medidas unilaterales que se pueden generar justamente a falta de esta solución global, pero la decisión creo que se va a tomar, o sea, no va a haber decisión hasta tanto no haya una ratificación de un convenio que obligue a ser parte de esta renta global, o bien a ir por una medida, ¿no? Como puede ser el artículo 12B, que sería a través de una retención. Así que bueno, eso es un poco la situación hoy de Argentina en el acompañamiento a la solución global y al resto de alternativas disponibles.
Thank you very much. I do believe that I made an error in not mentioning that Mr. Razmi Rajan Das of India is one of our panelists. And it may crave the indulgence of Mr. Baker to allow Mr. Rajan Das, who is a member of the OECD steering group, to make some comments before you come in. Thank you very much for your kind consideration. Mr. Das.
Thank you, sir, but I think I can wait till Dr. Baker makes his comments. There is no issue at all. So since I can wait, let Dr. Baker make the comments, then I can comment. No issue. Thank you.
Oh, okay. I thank you for your kind consideration. I was able to appeal to Mr. Baker because he's my friend. But since you've kindly ceded the floor to him, then I will ask him to proceed, and then we'll listen to you. Thank you very much. I appreciate this.
Thank you, Yemi. Delighted to be with you. Always a pleasure. Let me make sure everybody understands that the appellation doctor on the screen is decidedly incorrect. Yemi is a doctor. My wife is a PhD. I don't aspire to that elevated title. The panel, we are focused in this panel, we're focusing on alternative measures that can contribute to tax collection and economic development. Let me take the word alternative broadly and hearken back to the high-level panel on illicit financial flows from Africa, led by Thabo Mbeki, organized and directed by Abdallah Hamdok, former president of Sudan, Prime Minister of Sudan. Yemi has been a central person. Suad has been central in this effort. The high-level panel was created to address illicit financial flows out of Africa, seeing the loss of tax as part of the larger question of illicit money flowing out of the continent. The best data that we have indicates that Africa is in fact a net creditor to the rest of the world. What this means is that instead of richer countries supporting Africa, Africa supports richer countries. How is this possible? The fact is, for the past half century, we in the richer countries have created a financial secrecy system that is designed to move illicit money. This system, I think, as many of you know, comprises tax havens and secrecy jurisdictions and disguised corporations in the tens of millions around the world, more of them in my country than anywhere else. Anonymous trust accounts, fake charitable foundations. You can create a charitable foundation, you can donate your money to your charitable foundation, and you can designate yourself as the beneficiary of the charity of your foundation, dodging taxes at every step along the way. Another part of this system that has been developed over the past 20 years or so are hybrid entities. These are entities that can appear to be a corporation in one country, but the same entity can be treated as a trust in another country. It can be seen to make an equity investment in one country, which can be interpreted as a loan in another country. These hybrid entities have complicated the issue of that we're dealing with. Then there are all sorts of money laundering techniques. And finally, there are holes left in the laws of our Western countries that facilitate the movement of money through this financial secrecy system and ultimately into our economies. Sitting in the middle of this financial secrecy system is falsified trade. Trading in a way that is falsifying the identification and the amount of the trade and the purpose of the trade. The central focus of the BEPS process is trying to make trade legitimate rather than a mechanism for ill purposes. A key point that I make when I talk to groups such as you is that every element of the financial secrecy system has been created by us in the Western countries. Not a single piece of it has been created by drug dealers or human traffickers or terrorist financiers or corrupt government officials or what have you. No, this is entirely a creation of us. I have never known, and I've known a lot of, I've never known a multinational, multi-billion-dollar, multi-product corporation that did not use the financial secrecy system for the purpose of shifting disguised, usually illicit money across borders. Now, many people think that this is entirely a tax question. That's not correct. And the way that it is not correct needs to be grasped. Tax evasion and tax avoidance are the primary reasons for using the financial secrecy system in transactions between richer countries. For example, between Germany and the United States. But the same does not apply in transactions between richer countries and developing countries, let's say the United States and Nigeria. There, the primary motivation for using falsified trade, for using the financial secrecy system, is to convert soft currencies to hard currencies, to take soft country revenues and profits and convert them into hard country revenues and profits. In transactions between richer countries and developing countries, tax evasion and tax avoidance is very much a secondary concern. The primary concern is that conversion of currencies. My point is, the efforts to use exactly the same approach to addressing this problem, regardless of who is trading, is misguided. The motivations of the multinational corporations trading between richer countries are different than the primary motivations of multinational corporations trading between developed and richer countries. One size does not fit all in this agenda. Another question I want to address is whether or not, the basic issue that the BEPS process is addressing, whether or not falsified trading is legal or illegal. Let's take the US as an example, and there are laws in other countries that are similar. In 2005, in the United States, there was a case called US versus Pasquatino. In this case, the Supreme Court upheld a lower court ruling stating that using US mails and wires for the purpose of smuggling between the US and Canada was a violation of US law. Now, interestingly, this case did not hinge on who was defrauded, in this case, Canada, or of what they were defrauded, in this case, customs revenues. It simply said using mails and wires in a scheme to defraud is illegal. Every multinational corporation uses schemes to defraud hundreds of times a day in exactly the same kinds of transactions. Another case, US versus Giorgio, decided in 2015. The Third Circuit in this case addressed the question of the externality of the US wire fraud statute, this statute that applies to the misuse of mails and wires. In this case, US versus Giorgio, the court ruled that the explicit statutory language indicates that it punishes frauds executed in interstate or foreign commerce and is surely not a statute in which Congress had only domestic concerns in mind. Made it very clear the US wire fraud statute using mails and wires for illegal purposes is against the law. Third case, US versus Bingus, also decided in 2015. The Second Circuit ruled that, like the defendants in Pasquatino, a conspiracy to conceal their illegal trade in lobsters deprived South Africa of money it was due. The defendant's conduct in depriving South Africa of that revenue is therefore an offense against poverty. Why am I making this point about law? The BEPS process is trying to solve the problem of tax evasion and tax avoidance with a convention approach, a framework approach, rather than taking a stricter law enforcement approach. We in the richer countries want a global mechanism that does not accuse us of wrongdoing, that does not force us to think of this in terms of legal or illegal. Are there alternative measures that, even in conjunction with the BEPS process, can be useful in this connection? If I, and I have advised developing countries to greatly strengthen their own laws against falsified trade, what my recommendation is that, and let me be clear, a lot of developing countries have a little bit of this in one place, a little bit in another place, but not consolidated in a clear-cut statute. I would advise developing countries to adopt statutes that say whoever, in relation to the importation or exportation of goods, or in relation to trade in services or intangible property, whoever deliberately misstates, manipulates, falsifies, or omits a price, quantity, volume, grade, or other aspect of a transaction for the purpose of, one, evading or avoiding VAT, taxes, customs duties, other government revenues; two, obtaining a tax benefit, export subsidy, or other; or three, evading or avoiding capital or foreign exchange controls. Such action will be subject to civil or criminal penalty. I don't know of a developing country, Africa or elsewhere, that has a clear-cut law that makes, in all of its manifestations, trade manipulations completely illegal. I would get such a law in force. And notice, in what I have said, there's no difference between trade in physical goods and trade in digital or intangible goods. Next, with that law in place, I would add the requirement for a signature by the CEO of a local company or a foreign company on their annual accounts or tax returns or digital tax accounts, confirming that this law has been abided by in the preceding year. Even if you don't have an office in my country, sign it. If whether it's Twitter or Google or mobile, confirm in writing that you're abiding by our law. The power of the signature, to be perfectly honest, is greater than that of any laws or regulations that we can put in place. Sign it. Let me conclude. The BEPS process, and particularly Pillar 1, is trying to collect taxes while leaving the financial secrecy system in place. This will not work. It will have minimal impact for developing countries. We have to deconstruct the financial secrecy system if we are going to be effective. I'm recognizing that the BEPS process is a train that is moving and will continue to move. What I am suggesting is that we have to see this as an effort on the road toward making falsified trade illegal. I have a book coming out in 8 months called Invisible Trillions. And I make these and other points in my book. I stress, you cannot tax what you cannot see. You cannot regulate a secret system. We have to get rid of the financial secrecy system if these measures have a chance to work. Thank you.
Thank you very much, sir. Very interesting perspective. I'm sure we'll have some discussion around that. Without much ado, may I invite Mr. Rasmi Das to share his perspective hopefully we'll still have some time for an exchange of views. Thank you very much, Mr. Baker.
Thank you, sir, and thanks South Center and other organizers for inviting me. I must clarify that the views expressed herein are my personal views and not necessarily views of Government of India. Now, I must start with congratulating the authors of the paper that was presented in the last panel and for an excellent presentation by Abdul. I know it is quite difficult to make any projections for Pillar 1, particularly when we do not know the full rules. The Pillar 1 projections will not only depend on the amount allocation, which will again be dependent on the revenue sourcing rules, for which I think there are limitations now in terms of what is available in the financial accounts. That's on the one side. The other side, if we do not know the exact impact of the elimination rules, which is still under debate and discussion, the countries cannot simply look at what they are getting. They must also look at whether they need to surrender part of their revenue base. And it is not necessary that the countries which host the M&E groups or the countries which have substantial residual profits in developed countries will necessarily be the surrendering jurisdiction. It is quite possible, depending on the rule, some of the market jurisdictions may end up as surrendering jurisdictions. So when we compute Pillar 1, we need to keep that in mind, not only what we get, but also what we can possibly be asked to surrender. Having said that, I think like what my colleagues from Argentina said, India is one of the countries, it's a G20 country like Argentina, and which has joined the consensus, as we describe it as political agreement in October. Primarily because we believe the problem that we are facing, I mean, in terms of the international tax rules, which were framed in almost a century back, no longer working. And even as I think Dr. Becker was referring to, even from the tax perspective, I can add, I mean, still close to 26% of M&E profits gets booked in jurisdictions which have almost nil tax. And the profitability ratio, so employee cost to total profit, that ratio can be as high as 1600% in some of those low tax jurisdictions, whereas normally it is around 30 to 40% in so-called regular tax jurisdictions, which have normal corporate taxes. So the rules not only are against the market countries, which are primarily the developing countries, in a sense, the developed countries also equal lose out, but it also favors, I mean, the rules, as Dr. Baker was saying, were framed by the countries only, but it is being used by M&Es to park profit wherever they can, depending on their choice. And it's necessary that the international community comes together. So we see it as a global problem, which requires a global solution. Therefore, we do not see these problems of, say, lack of taxing rights for the markets or shifting of the profits only for the purpose of reducing the effective tax rate being addressed bilaterally, so change in bilateral treaties. Therefore, and the basic principle on governing Pillar 1 and Pillar 2, I think not only we should look at the Pillar 1 revenue allocation, we should look at the possible certainty factor in terms of amount B, which is quite important for most of the developing countries in terms of marketing and distribution profits that they can tax, and also the spillover from stopping the flow of profits to low tax jurisdictions. And equally important, which is under discussion, the subject to tax rule, which will help many countries to fight treaty shopping, a rule which is from the Pillar 2, the only rule which is really relevant for developing countries is the subject to tax rule. Now, so far as Pillar 1 is concerned, I think whether it is Pillar 1 or it is 12B, this has to be implemented through a multilateral process. I do not see, honestly, a bilateral process taking over either 12B or even a Pillar 1 something. It simply cannot operate because it is a global problem. We are looking at M&E group as a whole. And while, I mean, whether we go this path or that path, we feel that it needs to be global. And so far as pillar 1 is concerned, couple of comments before I close, because I think we're getting very close to our time. Maybe we can take some questions. One is, as Argentina also indicated, and as the chart indicated, countries which host the MNEs and countries which have the residual profits, they need to join. Without that, the pillar 1 will not work. But if the pillar 1, let us say, doesn't work and it doesn't come, then it is possible that countries also can simultaneously, not with pillar 1, developing countries can simultaneously look at 12B and multilateralizing it. I don't think 12B will work in a bilateral context. And second, while it is quite attractive to have a gross basis taxation, and always a gross basis taxation will give much more revenue, but ultimately, unless it is has some linkage, gross basis taxation works when it is a good proxy for a net basis taxation. But imagine a 4% tax on gross revenue, even if the company has 25% profit, at a 30% it will be 7.5, and even at 30% tax rate, it's 2.25. If you go for a 4%, you need to have a 50% corporate tax rate. So we need to balance that out. And because unless we provide, unless the taxation is reasonable, it will also be not be in the interest of growth, and revenue comes from only when there is economic growth. Only one thing I'll say before I close, we have 141 jurisdictions in inclusive framework. Now, it is not the time to decide whether one is going to join or not to join. But before that, instead of waiting for the product to come and then having a look at the product, whether I want to join or not, all countries must do their best to stay engaged in the inclusive framework so that they get a deal which they can perhaps sign up to. I think that should be the approach, that let us get a deal which we can sign up to. There is no point in waiting and not intervening in the inclusive framework debates, whether in TFD or where, and waiting for the product to come. That is not going to be very beneficial. And because ultimately, as the moderator said, it's a political economic decision, but as tax experts, so-called experts in this field, in the sense as professionals, let me put that's a better word, we need to give to our leadership a complete picture of, if we join pillar 1, what is the revenue? If we go for 12B, what is the revenue? And whether which is practicable, in the sense that, as I said, neither the 12B nor pillar 1 operate if major countries are not there. It is meaningless for two countries in developing countries signing a 12B agreement. It will not getting them any revenue. And second, what is the counterfactual of joining this or not joining this, whatever decision we take? So it needs to be an informed decision. So we need to articulate our views, and then whatever the final decision we take after getting the full picture, whether to join or not to join. But in the meantime, I think all of us, we are duty bound to engage constructively in the discussion that is going on. So at least we tilt the narrative in the favor of developing countries. Thank you very much.
Thank you very much. Yet an equally interesting intervention. Thank you very much. I noticed that Mr. Githi Umburu, Commissioner General of the Kenya Revenue Authority, is in the room. I don't know whether he would like to say something as well. Mr. Umburu?
No, sorry. This is Dr. Saidimo representing Commissioner General Umburu.
Okay, if you'd like to say a few words, we remember that we know for a fact that Kenya was one of the countries that said they would like to take a closer look at the issues. Would you like to say something? Or
thank you very much. We had indicated that Kenya was reviewing the report from the researcher. But of course, as you rightfully say, Kenya was one of the countries that did not sign to the OECD Pillar 1, Pillar 2 model. We're still interrogating the numbers. The good thing is that now we have the research papers. We're able to see the numbers. We are also interrogating with the OECD team. We're also engaging with the US government in terms of going forward. Kenya is one of the countries that has already implemented DST, digital service tax. So at the moment, we have our data, and we're trying to compare whether the amount A and what we're currently having is significant enough to convince the management and the policymakers to accept the Pillar 1, Pillar 2. Those are the comments from Kenya at the moment, but we're still interrogating the numbers. Thank you.
Thank you very, very much. I think we already have had a very rich exchange of views. Time is not our friend, but the interventions from Ms. Garcia, Ms. Gilles now, Mr. Baker, and Mr. Rasmi Das, I think have given us a rich enough menu. I'm not going to open up the floor to all questions. I'm just going to ask for one or two strategic interventions, if there are, to comment on the issues. For instance, some of the things coming out of here, which I can summarize quickly, is that even our developing countries who are members of the G20 feel, for instance, that it's a global problem that requires a global solution, and therefore we must remain engaged. They're pointing out, of course, that any system that evolves that doesn't have the major economies on the table might not be workable by itself, certainly not through a series of bilateral tax agreements. And of course, there's also the difficulty of what do you do about countries that have already implemented a digital services tax or a significant economic presence tax. And I think most important, listening to Mr. Baker, is that he's saying that it may be ultimately futile to solve the problem of taxation of multinational enterprises if we don't tackle the whole issue of financial secrecy. I'm not reopening the panel. I'm just trying to point out some of the issues that maybe one or two people want to respond to before we wrap it up. There's a question here, but really, I think it's a question that basically could have been addressed. Anyway, the question is, because taxation is a country specific, would it not be advisable to develop a model law which countries can use to address taxation issues? Well, I'm not a global expert there, but I know that there are model laws already. The OECD has a model law, the UN has a model law. So Article 12B is actually part of the UN model law. So I think that's the question already that answers itself. I don't know if there's any additional question, any pressing issues. Anybody like to say one or two things before we call it a day? I see not. Okay, my conclusion really is that the paper, I think, is very useful because all our authorities would need to have a sense of the numbers. I think one of the greatest weaknesses of the current outcome of the OECD Pillar 1, Pillar 2 is that there are no estimates to guide individual countries. I don't know whether the OECD has done it and spoken to individual countries, but in the public space, reading the paper put up and presented by our colleagues from the South Center, they've had to use proxy measures to try and get a sense of what the benefits revenue-wise would be. I think one key thing that would need to be done would be really for our countries on the revenue side to certainly know exactly what's on the table for either Article Amount A or Article 12B. But I think there are more fundamental issues at stake, and I think the discussion would have to continue because what do we do about countries that already have digital services tax that will make more than you will get from Amount A? These are issues that would need to be addressed. There are issues of representation. There are issues of the cake has been baked, and then you're asking me to come and take a small portion of the cake. In other words, issues of the IF is as inclusive as it can get. But to what extent does it really? I think there are only 23 or 24 African countries that are in the IF. We have 54 member states, for instance. To what extent have their concerns been met? And I think it goes back to the whole issue of making sure that everybody's at the table. But what I'm going to do is to give each of the panelists a few minutes to respond to some of the issues that have been raised by the other panelists. And I'll start again as I started with Ms. Garcia. We'll give Ms. Gilles now 2 minutes, Dr. Well, Raymond, everybody calls you doctor, so I have to call you doctor now. Mr. Baker, 2 minutes, and then Mr. Das, Rajan Das, 2 minutes. Ms. Garcia, you have the floor. Senator Garcia, did you hear me?
Hola, sí, no, no sabía que se refería a mí, perdón. No, está bien. Sí, para evaluar, si bien este estudio es muy ilustrativo y tiene muchos detalles y varias estimaciones, entiendo que también hay que tener en cuenta las limitaciones que tiene, ¿no? Porque bueno, por el tema de las bases a las que se recurrió, a las que se pudo recurrir, después no hay una segmentación de las actividades ADS híbridas, ¿no? Para ver cuáles serían ADS y cuáles no. Después también no se tienen claro cómo se van a trasladar las pérdidas, ¿no? Eso en el Amount A, en el Pilar 1, bueno, acá justo ahí. Y después también es el tema de la eliminación de la doble imposición, ¿no? Que eso me parece que es importante porque ahí los países van a tener que sacrificar parte de su recaudación. Me parece que eso es importante tenerlo en cuenta a los fines de hacer alguna estimación. En silencio porque están justo acá haciendo una protesta. Creo que eso es importantísimo como para tener en cuenta para hacer una estimación un poco más precisa a los efectos de tomar alguna decisión. Y bueno, y lo mismo respecto del Pilar 1, me parece también como que faltan muchas precisiones. No sé, Dolores, si quieres agregar algo más o con eso te parece.
No, respecto del informe, la verdad que no quisiera agregar algo más, solamente responder las preguntas la pregunta que hacía para el cierre el señor Di Pelú, de que cómo llevar adelante esta negociación, ¿no? Creo que es clave justamente, y como también decía Rasmidas, de poder lograr una contribución de todos los países, una negociación de todos los países, ¿no? Hoy creo que dentro de lo que es la discusión de la solución global del marco inclusive, se está intentando poder lograr esa solución global con las limitaciones que hoy por hoy tiene, pero que hay que seguir insistiendo en los países en desarrollo, que intentan, ¿no? Poder como bloque seguir defendiendo algunas cuestiones, ¿no? Como en su momento fue la cuestión de los mecanismos alternativos de solución de disputas, sobre la cuestión del arbitraje, que estaría plasmada hoy una solución opcional. Yo creo que tenemos que seguir trabajando en conjunto para poder, dentro del marco de esta solución global, poder obtener al final del día, cuando estén los instrumentos con todas las reglas más claras, poder los países tomar la decisión final, que es la firma o no de estos acuerdos, porque finalmente uno puede adherir a estos acuerdos, pero después estos acuerdos también tienen que pasar por los congresos de cada uno de los países, ¿no? Y son los congresos de cada uno de los países los que en definitiva tienen que incorporarlo, ¿no? Hoy por hoy, como decía anteriormente, lo que hay es un compromiso político a poder abordar esta solución de una manera global, que es la que se está dando en el marco del Pilar 1, ¿no? Con todos los pros y todos los contras que tiene para los países en desarrollo, como se ha mencionado durante toda la jornada de hoy en este debate, ¿no?
Thank you very much. Mr. Baker, 2 minutes.
Thank you, Yemi. I think that the question of digital service tax within Pillar 1 is key. I expect the United States will continue to oppose this because it's just a flat tax on the amount of digital revenues, and it obviates the ability of multinational corporations to use the financial secrecy system to manipulate their figures. I expect that the United States will oppose this, continue to oppose this, and I hope that there is some light at the end of the tunnel for developing countries to continue to use the digital services tax, those that want to. A comment on Pillar 2, which we haven't talked about very much, and its provision that corporations will pay a minimum tax of 15%. My great concern about Pillar 2 is that a 15% tax is a step on the road to zero tax paid by corporations. And to me, that would be an extremely serious development within the democratic capitalist system. I know of nothing that would drive economic inequality more than moving on to a zero tax on corporations. So I'm very concerned about moving to 15% because I think it could be a step toward corporations getting out of paying taxes altogether. That would be a drastic development. Thank you, Yemi.
Thank you, sir. Mr. Rasmidas.
Thank you. I think I'll be brief, just 2 comments. I think number one, this panel report, that report that was presented is quite helpful. But ultimately, I think any decision on any tax has to be taken. Always the leadership will ask for the revenue figures. And I know any global level analysis will always have several assumptions. So it is at our country level, we have the best granular data. It's on us to exactly examine as and when a Pillar 1 unfolds, and we of course not well be connotations. What is the revenue, possible revenue, as we do whenever we legislate a tax policy measure or any tax measure? So that's necessary to know what is our gain and what is our loss. This is number one. That needs to be done for every country. Then, of course, the countries can take their own call. In the meantime, as I said, not only instead of waiting for the final result, we need to be engaging in the discussion, trying to change the narrative in favor of the developing countries. And for this, we need to build coalitions. And that is more important. That I think in most cases, the developing country interests converge. It's necessary to be together and to speak together so that on major issues, including, let us say, elimination or even marketing and distribution safe harbor, these are the issues which can substantially affect the developing country tax base. So where we can speak in one voice, and of course, I think that is necessary so that we know what we are signing up to, even if we're deciding to signing up to or not signing up to. Thank you very much.
Thank you very much, Ms. Patricia Garcia, Ms. Gilles Nall, Mr. Raymond Baker, and Mr. Razmir Rajan. Thank you very much for what has been a very illuminating and very enlightening session. Far from me to try to summarize what you've all said. My interest would be for the South Center and CODA to please continue the conversation. What has emerged today is that the issues are such that we cannot just assume that we thrash them out and go back to our respective abodes. We have to continue this conversation. We have to continue to think it through, not only in terms of the numbers, but in terms of the architecture of governing and the global taxation system. With that, I hand over back to Ms. Wada Den Osman, Executive Director, CODA. Thank you very much. Thank you to my panelists, and thank you for a very, very illuminating session.
Thank you very much, Dr. Dipiolu. This has been an enlightening second dialogue. The Coalition for Dialogue in Africa and South Center organized. We have organized the first one last year in December, 16 of December. The outcomes seem to be speaking to the same kind of conclusions, but at least this time around, some data at country level is available, and I agree with the Kenyan Revenue Authority representative who said that we are interrogating and examining the data, and that is exactly what the high-level panel on illicit financial flows, the Secretariat of the Coalition for Dialogue on Africa hosts at the moment, is going to do. Raymond Baker is part of the panel. They have launched what they call now phase 2 of their work, which is at national level. So as far as the Coalition for Dialogue on Africa is concerned, I agree with Dr. Dipuolu. The conversations will be entertained at a global level. We will continue to shape the narrative and force at least a global South fitting one, but the main work has to happen at national level. There has been a tax deal that is coming out of a multilaterally negotiated text cannot be emanating from a process that most of developing countries are feeling it was not fair. It has to be fairer. The process itself has to be fairer. The platform therefore matters. OECD versus United Nations. I agree with Mr. Razmidas. We cannot throw something when we don't know really what it is that we are looking at. But it is with those few words, it is really my pleasure on behalf of the Coalition for Dialogue on Africa, the African Union High-Level Panel, the South Center, to thank you all, our participants, our researchers at NARA, the editing team at the South Center, led by my brother Abdul, who did an excellent job in editing the paper. The information is out there, can be looked at and interrogated. We will continue to engage on this. I really wanted to most sincerely thank the moderators, the panelists, our presenter, Abdul, he was only one presenter, the interpreters, and mostly all our participants and the two teams, both in CODA and the South Center, who make this happen. We have passed already 11 minutes. We were supposed to conclude at 6. Thank you very much. Please stay tuned. We will continue on this. South Center is very advanced compared to CODA on this part. They will continue to generate the information and the data. We, as a platform for dialogue and debate, amplify it, particularly on the African continent, and we will take it from there. Thank you, everyone. Dr. Baker, thank you very much for joining us. You're the only representative of the panel. We do this because of the panel on illicit financial flows. Thank you, everyone. Goodbye.
Thank you. Ugh.